Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas. You've seen a property sitting on the market for a little while, and you're thinking about making a lowball offer on that home. Stick around. In this video, I'm gonna teach you why that's a terrible option. So listen, the Dallas housing market continues to be strong, even in an economy that seems to be semi-weak. And what we're seeing now is, with the market softening a tad, even though interest rates have dropped some, we're still seeing opportunities for buyers to go out and get a property and get a good deal on the price. And what's happening is the buyers are pre-approved with us. They're going out and shopping. They're seeing a property that's been sitting on the market for a couple of weeks, sometimes even a couple of months. And their first inclination is, ooh, this property's been sitting for a while. I want to lowball the offer and see if I can get a deal on a house. So I'm going to tell you in this video why it's a bad idea and how you should structure your offer, obviously with the guidance of your realtor, but on the home loan side, I'm going to give you the perspective on my half. So the reason, number one, that we don't love when buyers lowball offers on properties, first and foremost, obviously, is it sets the comp in the neighborhood. So let me give you an example so it's easy to follow. Let's say you've got a $600,000 property that's been listed for a couple of weeks. If a buyer is going to look at that house and they think, man, this thing's been sitting for a couple of weeks, it's $600,000, maybe I can get this deal for $570, their first inclination when they make an offer is to ask for the concession off the price. The problem is, let's assume that you make an offer at $570, it gets accepted. You as the buyer feel good that you got a $30,000 concession. The problem with that all of a sudden is when that transaction closes, you're super happy, you've got your keys and you're a homeowner. The psychology of the sale and the comparables in the neighborhood is now set based on your comp. What does that mean? It means for the next buyer and the next real estate agent that's shopping in your neighborhood and they try to pull up online what recent homes have sold and what they've sold for, what they're going to see in the appearance is, hey, your house was listed at 600, you got it for 570. So in their mind, they think, oh, this neighborhood is maybe a little bit weak. It may be declining, and it's our opportunity as the next buyer to try and get a deal on the next house. So let's say the next house is listed at 570. It's been sitting there for a week or two or three, and all of a sudden they say, you know what, this person just got a discount 2 months ago. This thing's at 570, let's offer 555. So let's say they make an offer from 570 to 555 and the owner accepts. Okay, great. You got a deal on your house. They got a deal on their house. Now what happens? Well, the house that was listed at 600 is now 570. That's a comp. Your house that was, or the other person's house that was listed at 570 is now 555. So when an appraiser or a mortgage company or a real estate agent next time around goes to pull comparable sales, they're going to pull those comparable sales and say, this one sold for 570, this one sold for 555. Now those two are the comparables for the rest of the neighborhood. So why is that bad? Well, you do not want to kill equity and you do not want to kill wealth in a neighborhood. Properties are one of the best ways and the most common ways that people create wealth and use for retirement, cash out, debt, college, home improvements, you name it. So what happens when it comes to comparable sales is, people can only go off of the data that they have, and they use the most recent data, and they not only look at what the sold price was, they look at the list price. So I want to flip this and give you a little opposite perspective on how I think that you should make the offer and why. So let's pretend like that same house is out there at $600,000. It's been sitting there for a couple of weeks or a couple of months, whatever it is. And you say, hey, I want to get this house for 570. I want to get 30K off. So what I recommend is, instead of having the $30,000 off the price of the house, I would say, hey, do me a favor, make the offer price at $600,000, but ask the owner and the seller for $30,000 in closing cost. You are still getting the $30,000. The owner is still agreeing to give up $30,000 of their money. It's just that the money is being taken and put into a cash closing cost credit versus off the price of the house. So now what happens? Okay, let's say they accept at $600,000 with a $30,000 concession. Number one, when you close and you have your keys this time around, that house was listed at $600,000 and you bought it for $600,000. So now the comparable in the comp in the area is $600,000. Number one, the psychology of the sale. It was listed at 6. The buyer bought it at 6. This area is not weak. It's not declining. It's holding strong. So that way, the next buyer that comes in not only will see that what it was listed for, it was bought for. It doesn't give any acknowledgement to declining value in the area. That means the next person that's going to buy is probably not going to lowball the next one. And all of a sudden you have your comp at 600,000, they have their comp at 570, whatever it is, and now they're holding strong. That matters for a few reasons. One, you don't want to kill wealth in an area. Two, you as the buyer, let's say you did it the original way around with 570. If you put 10% down and that area continues to decline over 6 to 12 months, the problem is that 10% you put in equity, some of it might go away. So if your value continues to go down because you and the next person see this decline and everybody wants to go to the bottom, it'll steal the hard-earned money that you put in as a down payment and steal some of your equity, which is what we don't want. The other component about that too is, let's say that you wanted to refinance in a year, in 18 months when rates start to drop to better improve your financial position on the rate and the payment and the details. Well, if you bought your house at 600, the chances of it dropping down to 570, 560 over a period of time isn't good because you're setting the pace for the comp. So the next person should buy right around the price, and if they buy around the price, the next person will buy around the price and you'll keep it stable. That matters not only to protect your equity, but also from a refinance standpoint. If you put 10% down and you come back to us and I take care of you in 12 to 18 months and refinance you, if you bought it at 570, but since you bought, 2 or 3 comps have also bought and they've lowballed, the problem is your 570 may drop to 555. And while you may have an opportunity to get your equity back later, whenever the interest rates drop and the price goes up, your loan to value on the refinance will change. And that's a big thing because people are saying, hey, my mortgage right now is going to be short term, 12, 18 months. I'm going to refinance in the future. That's great. But you also have to have the equity in the property to refinance next time around. So if you do 10% down and it's a decline, when you come back to me, you do a refinance, you might be at 95%. Naturally, 95% is the maximum on a refinance, or maybe you are at 92%. But of course, anything with less than 20% on a conventional loan is going to have PMI, and PMI is graded based on risk factors of 5% increments. So it goes 100 to 95, 95 to 90, 90 to 85, 85 to 80. I say all this because if you are at a 82% loan to value, your PMI is basically nothing. If you're 92, it's a little bit higher. If you're at 95, it's higher. So not only do I want to make sure and protect your equity and your wealth for your own hard-earned money that you pay taxes on and put into this down payment, I want to make sure that next time around when we talk, none of that equity is gone. Now, while lower interest rates over the next 12 to 18 months will definitely push up demand pushes up prices, you're going to make money back on the upswing, but there's no reason to give away the equity if you don't have to. And obviously making an offer and lowballing on the property will only kill that comp. Now, let's go back to option 2 that I discussed earlier, which is if the property is $600,000 and you offer $600,000, you get a $30,000 credit on the back end from the seller as like a cash closing cost credit. What do you do with that credit? Number one, you want to pay your closing costs with it. Okay, remember, buying a house in this fashion or form is similar to buying a car. You buy a car for $40,000, there's $2,000 in tax, title, and license, so you as the buyer are actually responsible for $42,000. Same thing on a home. You buy a $600,000 home, your closing costs might be 10 grand, so you owe $600 for the house, $10,000 for the closing costs, so the total due to you is $610,000. What you can do in that scenario where you buy it for $600,000 and you get a $30,000 credit is take $10,000 of that closing cost credit and use to pay for the closing costs. What that does is saves you $10,000 out of pocket, so that way you have more cash flow for yourself to do something else with, pay off credit card debt, put more money down, or even save for a rainy day. So let's say you got a $30,000 credit and you use $10,000 to pay for the closing costs, and you're like, Brian, but I've got $20,000 left over. What do I do with it and what can I do with it? Great question. So most people right now are sensitive around interest rates and monthly payments, aka affordability. What most of the clients are doing is they're taking that $20,000 and they're buying down the interest rate temporarily for 2 or 3 years, up to 2 or 3% for the first year or 2 or 3. And what it does, hypothetically, if your starting rate is 7% and you do a 2-year buy down with a 2% lower start rate, that means your payments for the first year are going to be 5%. And your payments for the second year are going to be 6%. If you do a 3-year buy down, that means your first year interest rate is going to be 4%, second year 5%, 6th year 6%. So for you, you're taking that extra $20,000, you're buying down the interest rate dramatically, temporarily for the next probably 2 to 3 years max, knowing that you're not going to keep that mortgage forever and you're going to refinance in the future. So what happens is your payments are much, much cheaper as a starter rate and a starter payment until you get to where you want to refinance. So here's the cool thing about temporary buy downs. If it cost you $20,000 from the closing cost and have the seller pay for it to get your interest rate down 2% for a 24-month buy down. Let's say refinance boom comes around in 12 months and everybody's like, I'm ready to refinance. Rates got lower faster than we think. We're ready to go. Well, the temporary buy down, if it cost you $20,000 to do it for 24 months, aka a 2-year buy down, and you only use up 12 months of it, and you refinance and reset the mortgage, any unused money from that temporary buy down, or in this case scenario, that $20,000, will be fully refunded back to you as a check in the mail. So if it's $20,000 to buy it down, you use $12,000 for year 1, there's $8,000 allocated for year 2, we refinance on month 12, we go back to a permanent mortgage with a cheaper rate because the refinance market is now hot. That $8,000 of unused money comes back to you in full as a check in the mail. You can use that to pay for the refinance, you can put money in your pocket. Sometimes I help clients with what's called compound saving. They'll save money on the refinance, they'll take the refund money from the temporary buy down. Maybe they got a credit card that's $8,000, $9,000 and it's $200 a month. So then they'll use that refund money to pay off the credit card. So if we save them $300 on the mortgage on the refi, $200 on the credit card over here, that's a total combined savings of $500. This is the way that you maximize your funds and make sure to put yourself in the best position possible from a monthly payment and a cash flow standpoint. Not only on the mortgage, but on your other debts as well. So I want to reiterate this because we're seeing this a lot in the market right now. I think it's going to stay this way for a while. And so if you're a buyer out there, obviously, and you are looking to buy a property, you find a property that's been sitting on the market for a couple of weeks to a couple of months, first and foremost, talk to your agent. They know best. But as a financial guy and a certified advisor and a mortgage planner, I see this all the time. And one of my biggest goals and the things that I like to do for clients is the highest and best use of the money. Number one for the clients, but also to make sure we protect the equity in the area so we don't kill wealth, we don't have any issues on a declining neighborhood, and we don't have any challenges next time around on the refinance, because for you, it's about getting the best deal. And if you can get a deal on a house and get a concession from the seller, do not take it off the price. Put it in the closing costs. The comps will stay strong. It'll protect your wealth. You can use the money for a much, much higher and better use of the funds for closing costs and interest rate buy down. And if you do the interest rate buy down, it'll make your payments much, much cheaper for the first year, 2 or 3 years, depending on what you choose. And obviously, if you refinance before that term is up, you get a full refund check in the mail for the unused portion. It's the best way and the smartest way to make offers in this market if you can get a deal on the house. So listen, I hope you found this video useful and helpful. If you did, do me a favor, like, comment, subscribe, even share this with somebody that you know that could benefit from this information. And if you need me or our team in the meantime for a pre-approval financial consultation to talk about the state of the market or anything that's on your mind, feel free to call us, email us, or text us. We are always here for you. In the meantime, stay tuned.